It has been a brutal month, but I guess we can chalk it up to a slew of things. People are believing this is a peak earnings that we're seeing right now coming through. You do have a increasing yield curve in the U.S., obviously, the hawkish Fed. China growth is slowing. You have the Italian budget has a problem as well. You have the midterm U.S. elections as well. And the market never actually does well into those elections, by the way. And I would just say blame it on Trump. Everyone else does, so let's just pick on him for a while. But historically, the October month has been one of volatility. It's obviously living up to its name. And the momentum trades, the healthcare stocks, the FANGs are not immune. And actually, that trade is unwinding. So these high-flying, defensive, large-cap healthcare names are obviously, as I said, not immune. Definitely getting reacquainted with some gravity here. We're seeing, down 5 points since the last month. That's about 15%. Have underperformed the broader market about over 5% since that time. So not surprisingly, the richly valued, I think you call them glamorous names, the CSLs and Cochlers of the world, have been taking it on the chin. They're down 20% over that same time since early last month. Now, on the way up, we actually call this as more or less investors were a little irrational exuberance. I think that's a Greenspan term we quoted, saying, we were trimming these names on the way up. Now, here coming on the way down, what are you going to do with them now? They definitely look more interesting to us. And we were looking to maybe dip our toes back in the water at these levels. However, I would caution you, and it's a big caution, this is a toe. It is not a foot. It is not a leg. Okay, this is a difficult market right now. I think you have to be very nimble. You're more or less a trader. You're not really an investor per se. So you have to be in and out of these names. Obviously volatility is back with, we would say, with a vengeance. And what has worked for years, the buy the dip philosophy, it only works until it doesn't. Take a look overnight in the U.S. and see what happened to that market. So let me just run through quickly some of the specific names to kind of give you a feel for where we're going on those and what we believe is a good entry point for these names. So first and foremost, obviously CSL. Despite it being down 20%, it's still not cheap. Believe it or not, it trades at 29 times forward earnings. That is one standard deviation rich on both an absolute and relative PE basis. It has an implied terminal growth rate. This is of 7.4%. This is on an inverted DCF. It's a nice way to see what people are factoring into perpetuity for these names, and that's quite high. It obviously, as I said before, CSL has been living in what I call a purple patch for the last couple of years, as a lot of its competitors, or a slew of its competitors, have fallen over. CSL is a great operator, and it's done well to pick up the pieces there, but those days are numbered. It is reinvesting the most it has in its 100-year history. I said this before. R&D is up 20 to 50% year over year, and CapEx is going up 50 to 70%. So they are spending, which is a good thing, but near term, it's really compressing their margins and their profit. So the risk profile, I believe, for CSL is increasing. That's nothing new. I've said this time and time before. As I said, the earnings growth is coming down. 35% earnings growth it did in the first half last year. It came in at 19% in the half just passed, and they're targeting 10 to 14% growth this year. So you can see where that growth trajectory is going. It's going down. But I said it's interesting for a trade at these levels. Well, where am I an investor? Where am I going to pick this thing up? I think around 170. That's our DCF valuation. 170. I'm buying CSL as an investment. Well, I said you can trade this thing all day long, but you have to be nimble. But we're looking really for an opportunity coming in the back of first half earnings. I know it's a little early to talk about first half, but guess what? It's right around the corner in February. I was just running some numbers the other day and thinking, they're comping a 35% hurdle. That's very high. And last year, if you recall, in the first half, the flu season was very, very bad, the highest in 10 years. And now this year, it seems pretty benign. Now, North America has yet to hit its peak of its flu season, but coming off of the Australian flu season, which was kind of lame, so for lack of better words, it isn't looking good. And that's where CSL drives its profit. It's a big swing factor for CSL in the first half, so that's looking quite soft. So there could be some downside risk in the first half. Looking to pick up the name there as an investor, okay? Cochlear, much more expensive than CSL, believe it or not, trading at 36 times forward earnings. That's above one standard deviation rich on a PE relative and absolute basis. It is reinvesting like CSL into its pipeline, which is good to see, trying to maintain its R&D kind of leadership there, really focusing on driving market growth via really a service-orientated B2C model, which we think has a little more time to play out. But you can play this as a balance. I mean, offshore investors love this name. Is up 3% yesterday. It's going to give that back probably today. But where I would pick this up as an investor, my DCF is calling for 160. I do like it around that level. Moving on to ResMed, our quasi-IT FANG stock. It's down 8% since last month. It's more than 15% upside to our price target, roughly 16.50, give or take. We really flagged in a last note, a note recently that the Q1 earnings, which will report out tomorrow morning, could disappoint. Now, earnings for ResMed is very difficult to call. They don't really guide you. They're quite volatile. But Q1 is historically a softer quarter, and they are comping some high hurdles in front of them. So I was going to say be more cautious than not, maybe take some off the table. If you're in the name, if you're not, wait to kind of look and see what's happening in Q1. Don't think the wheels are going to fall off the name if they do miss, quote unquote. I do like their connected care offering. It's leading the market. They are doing interesting things above the market leaders. And I do like that name longer term and really looking to fuel double-digit growth on their connected care offering. So I do like it still today. Moving on to Sonic Healthcare, pathology provider, also down 8% over last month. We do like the company at these levels. I mean, I think a fairly stable earnings trajectory, kind of underpinned by really strong organic lab growth. Really, I'm looking at a benign near-term regulatory environment, but that's a swing factor. I mean, it's benign today. Tomorrow I wake up, it's not. I mean, this is what happens with these names. But it does have a pipeline of acquisitions in front of it, about $650 million in headroom to do that. This is a very simple model. Unlike a lot of the names in our space, it's all about scale efficiencies, and they need to get more under their belt, acquisitions that is, to write this model up, and they're going to do that guaranteed. So I still like Sonic at these levels. Industrial name Ansell is the only one across our list. It's a cyclical name, down 10% since last month. It kind of falls into too hard basket for us, really carrying a lot of uncertainty. Not even, and you can even see that in their own guidance. Their guidance for EPS is -2 to +10%. You can drive a Mack truck through that hole. It's just too hard to fill, and then they came out with their AGM. They reiterated their guidance. Okay, that's good. Then they said it's second half skewed. What do you do with it? Too hard. You're really doing the company that's really affected by increasing raw material prices, which are going only that way. And you have tariffs. The problem you're seeing in Q3 in the States right now, people are a little more concerned with the tariffs. I flagged this last quarter, saying this is coming through. And for Ansell, tariffs are material. If they exacerbate and have more problem going forward, there's kind of risk there. So Ansell, I wouldn't touch it now. Where does it look interesting as an investor? Below 21, I'm picking Ansell up. Lastly, I'll turn to the hospital operators. Get lots of calls on, of course, the Ramsays and the HealthScopes. Firstly, on Ramsay, down 5% since last month. So it's fared a little bit better than the rest of the names, but it's already been derated into this last month, I would say. Top quality operator. Nothing's changed my mind there. Fundamentals of the industry, I still think longer term are solid. But you know what? This company's likely to tread water. The stock's not really going to go anywhere. They still have their offshore businesses that are not going too well, kind of struggling there. The outlook is soft. They're calling for 4 to 6% EBITDA growth in this year. They're not really moving the needle much. It really requires a costing out and really the Australian division to really kick on. And I think in this environment where it's soft utilization and the affordability issues still front and center, it's going to be very hard for them to kind of pull that out. We're still relying on the brownfields. That's still going strong, and procurement savings, going through the model, but they're kind of 2020 weighted on the fiscal year. So I think in 19 is going to struggle. And of course, don't forget the latest foray into buying this Swedish hospital group Capio through their French division, Ramsay de Santé. You just throw this more into the works. This is really challenging. Obviously, it opens up their markets in Europe as well as the Nordic regions, but still hard to get your hand around it. There's still a lot on the plate right now. So I'm kind of sticking back thinking, you know what? Not going to go much. You're not going to go very far right now, but below 50, I'm a buyer. That was the bottom line for Ramsay. HealthScope, wow, what the heck? A lot of things going on with HealthScope. Obviously, it's popped up because BGH and Australian Super came back in play, kind of reviving their $2.36 per share cash offering for the name. So I'll pop that thing back up from the 180 mark. But it's interesting. I wrote a note. I won't belabor this and go into the nitty-gritty details, but I wrote a note a couple of days ago, or I think I put out last night, about my thoughts on that. It's kind of a head shaker of why now. Obviously, the board is under more pressure now. The AGM is next Wednesday. But they've given BGH the cold shoulder back in May with this offer. The offer was not sweetened. It's exactly the same offer. Yes, they got Ellerston, which is a 10% holder, on board. So it gives them a little more weight, shareholders behind it, for at least Healthscope to crack open the books. Will they do that? Will the board capitulate this time around? I don't know why they would, to tell you the truth. I mean, from anything from last April, the company has actually improved its operations and cleaned up its unperforming assets and actually divested its Asian assets, got rid of some hospitals as well, and now is in front of the Northern Beaches. That's where their focus is. That's opening up next week. You can read in my note I just published. So I'm thinking that they'll be jilted once again. Now, I could be wrong. I don't have a crystal ball on this thing. Bottom line is here, if you're in the stock, I would look to take some off the table, because if they do give BGH the cold shoulder again, you know where the stock's going to go. It's not going to maintain its current levels, albeit that BGH has locked up Australian Super until March next year. So don't think they're not going to be waiting on the sidelines for this thing maybe to crack on the Northern Beaches not going too well. But bottom line is, I think the stock sells down. You may want to wait till Wednesday in the AGM and see what the heck they're going to do, or whether the books or not. But I'm thinking, you know what, why am I going to hold it here? If you made a little bit of profit, I think take some off the table now just to be safe. Sorry, I tripped on too long. With that, I'll throw it back up to Scotty, run through some of the aged care sector. Obviously, that trade is looking quite hard right now, given what we're flagging in front of our Royal Commission. He also talked about some small caps. Some of them have been running really quite hard, even given the market volatility, which is interesting to note. But with that, I'll throw it up to Scott.
Very quickly on aged care, just ahead of that Royal Commission, we are staying with a very cautious stance. Really don't see any reason to speculate what might be the outcome with that. We've moved our price target on Japara down to maintain that whole rating. We have the AGM for Regis out today, so we'll get some comment on that. We expect them possibly to see a higher cost base coming through, so no real reason to be in the aged care operators. One of the more exciting stocks in the emerging healthcare space is Volpara, the digital healthcare company that's aimed at assisting the early detection of breast cancer. Their share price has been very strong recently, run through our target. They have their quarterly result out on Monday. We have suggested trimming some overweight positions, but it is a key call, and we are coming into a seasonally weak quarter. So we'll get some more feedback from the company on Monday when they report that quarterly. If there is any weakness, quite possibly today, we'll be looking to go back onto the front foot, but at the moment it has run through our price target. So that's Volpara. It is a key call for us. I just want to highlight Nanosonics. Like some of these other high PE healthcare stocks, they have fallen 20%. It's now looking like heading under $3. I think that looks really interesting again. They have said that they'll bring one or more new products for the infection protection market into production by the end of FY20. So that will give them another leg of growth. I am looking to become more aggressive. Currently got a whole rating, but if it does slip much below $3, Nanosonics is certainly worth having a very close look at. Smiles, again, that share price has been weak. It's trading 10% below its IPO price. We've recently spoken to 4 dentists within the Smiles network. They've reported back that they're happy with the model and it's all progressing well. They all did say they did have some teething problems, but the Smiles team were very responsive in addressing all the issues and that they've now been resolved. AGM is coming up shortly. We expect them to reconfirm their guidance of NPAT of $6 million for FY19. It has it trading on a P of less than 8 times. So I think it's very good buying at the moment. That Smiles.
Hey, Scotty, on Smiles, there's a competitor IPO coming from Wilson's, I think. Is that a similar business model to the other listed players, or?
Yep. So Benny, a similar business model to the other operators who'd buy out 100% of the practice. So the Smiles model basically leaves the dentist with 40% of the profit, so he's incentivized to keep growing. So it is a different model. And just finally, ResMed has gone into a voluntary suspension just ahead of some technical delays ahead of their results for their US respiratory trial, which is due out on Monday. So we'll keep you posted on that. That's it from healthcare.